Welcome to Investors Guide. You're watching ET Now. I'm Faye D'Souza. Remember, on this show, we'll help you sift through the market and pick the right investment policies that you should start investing in right now so you can be rich over the long term. Remember, you can send in any question you have about saving, spending or investing your money. Our email ID is at the bottom of your screen, or you can reach me personally on Twitter as well. This week we'll give a young investor a strategy to achieve his goals over the next 20 years. In our product review, we look at the Birla Sun Life 95 fund. All right, it's time for me to bring in Narendra, the CEO of Value Research. Narendra, thank you so much for joining us on Investors Guide. It's always a pleasure to have you. Let's get straight to our portfolio question. Well, 36-year-old Vivek Nair has written in Narendra. He makes 1.6 lakh rupees a month. He's married. He tells us both his wife and his mother depend on him and his salary. He began investing about 3 years ago, and he has these goals in mind. He wants to put together a retirement corpus of, today's value of 3 crore rupees. He wants to buy a home of 60 lakh rupees, and he wants to save for his child's education in the future. Now, he does seem to have enough health insurance, and he has some life insurance in the form of a term plan for 50 lakh rupees. We'd like to have him increase that to 1 crore rupees if possible. And he has 12,000 rupees going into the PF every month, and an additional 9,000 rupees going into a voluntary PF every month as well. It's about 18 lakh rupees in fixed deposits and some money in gold. And he began, and this is the beauty of his entire case, Narendra, he began investing in mutual funds 4 years ago with a small amount of money. He now puts aside 50,000 rupees every month in a list of funds, and he plans to increase that every year. Now, before we get into the list, and it's quite a long list of funds, and we'll go over that list, Narendra, just from first glance of his portfolio, is there anything particularly that you'd like to change? Perhaps, the 18 lakh rupees in his fixed deposit, the 10 lakh rupees in his PF and VPF, is that an amount maybe he'd want to bring down a little bit?
Yes, I would certainly think, because, he has very aggressive plans for his retirement, because 3 crore now at current value, and 25 years from now, it will be a very significant amount. So for that, and he has ample time on hand. So that's unlikely to be an issue. And he will, and the way he is focused on saving and accumulating his savings, and the way he has been able to pick up mutual funds and be methodical about it, I don't think it's a very difficult target to achieve. But I think these things will definitely help. Having this large fixed deposit, he should have a fixed deposit. It should be a deposit with some objective, the money which he is likely to need. And he should have enough money for whatever needs it be, whether it be emergency or some money which he is likely to need in next 3 to 5 years. He should have it handy for sake of mental peace, and not to worry about any of those medium-term objectives. But long-term accumulation or regular savings going into fixed income by way of that voluntary PF. If voluntary PF is a negotiable one, which means that if he can discontinue it, and if it was done with a primary objective that he will be able to save tax under Section 80C, that he should try and discontinue. And that 9,000 rupee can well go into a tax saving fund. So it will get him the benefit of tax saving. He will get the tax break, but he will that investment will be a growth oriented, and it will be a very desirable thing.
All right, so here's the advice. You need to keep a little bit of money in your fixed deposit that you can use as an emergency fund. Increase your allocation to equity because you have very aggressive goals. And of course, from my end, always health insurance and life insurance are very, very important. Let's take a look at the mutual funds, Narendra. This is so interesting. He said he started with a small amount of money. He's now putting aside 50,000 rupees every month, and he plans to increase that amount by 20% every year. Now, here's a list of funds that he's investing in. He has the DSP BlackRock Microcap, HDFC Midcap, HDFC Equity. I'm not going to go through the entire list because there are 10 funds, and they're quite haphazardly put together. There's an export services fund, there's a banking fund, there's an equity opportunities and a pharma fund. And he knows he has one too many funds, so he wants us to help him bring down that number. Would you like to bring him down to about 5 funds ideally, Narendra?
I would suggest that he can well consider our aggressive portfolio, and his portfolio is also good. He has chosen funds carefully, and the advantage of doing savings, doing your investments through SIP is that the first hurdle that you face is get started with any such thing. I would think that it is go with a diversified fund. But it is better to get started with something even in a wrong way than not get started. So from that standpoint, I think he has chosen good funds. He can do without all the sector funds, so that itself reduces the 3 funds, and then reducing the mid cap. And if I have to reduce, if I have to choose from one of the 3 HDFC funds, I will go with HDFC equity fund, simply because it is a kind of portfolio which is a mix of HDFC mid-cap opportunity as well as top 200 fund, and he is getting the benefit without the added dimension. He will not have to track these 3 funds, and he is getting all the expertise. So that itself will reduce his portfolio to 5 funds.
All right, so just to give you a recap on the 5 funds as they are now after Narendra cleaned it up for you. There's the DSP BlackRock Microcap, HDFC Equity, ICICI Prudential Focus Blue Chip, iPru Value Discovery and Reliance Equity Opportunities Fund. So you could just bring it down to this list, which will serve you just fine. Or you can use our aggressive portfolio. Our aggressive portfolio is on your screen right now. So remember, emergency, health insurance, life insurance, and Narendra there saying, if you have aggressive goals and you're looking to invest for the long term, 15, 20 years, like you said you were, then you should be using aggressive equity funds, and those options are on your screen right now. If you'd like us to take a look at your entire portfolio, write to us. Email ID is at the bottom of your screen. Send in a contact details so we can call you if we need more information, and it'll be our pleasure to help you on this show. Let's take another question. The Deepak Seth has written, and he tells us he's a new retail investor. He wants to put aside 5,000 rupees every month in an SIP and an ELSS, and he's shortlisted Reliance Tax Saver or the Axis Long-Term Equity Fund. He wants to know which of the 2 is a better option. He says it's interesting because he's been looking at the Reliance Fund, and it does invest a fair amount in mid-caps. So he wants to know, for someone with a long-term horizon, which of the 2 would you recommend?
Reliance Tax Saver and Axis Long-Term Equity both are excellent tax-saving fund, and as part of our recommendation, both figure there very prominently. So it's a difficult choice, but I would say that Reliance small cap tilt makes it a little more volatile, but volatility doesn't matter in a tax saving fund, because once you invest, you are invested there for at least 3 years anyway. And if that translates into superior return, and if you're investing for much beyond 3 years, 3 years should not be your view when investing in any equity. So I think it's a fairly good aggressive fund, and it will do over any 5, 7, 10-year holding period for your regular investment. Likewise, Axis Long-Term Equity is an outstanding fund. It is not focused. This will be able to tide over any such cyclicality a little better. And so it's a difficult choice. But if you're looking for aggressive return, maybe Reliance Tax Saver, little greater stability, Axis Long-Term Savings.
Then a very quick question for you. He also seems to be concerned a little bit about their expense ratio, because he's compared them on every possible platform. Now, one of them is at 2.34, the other one is at 2.55. There isn't a very large difference. So for any investor right now who's considering an investment in an ELSS, which means that it's a 3-year investment in the very least, and it might just be longer than that, how important is it to take a look at the expense ratio? And would a small change like 0.2%-ish make a difference at all?
Yes, absolutely. It will make a difference. Every small change matters here, because you are investing, and because it is effectively a compounding in reverse. Exactly the way your small amount of money accumulates into a large sum over a long period of time, simply because of superior return compounds over a period. Likewise, a small expense translates into a significant. If investors don't get an opportunity to see, if they have invested 10,000 rupee month after month for 10 years. It will accumulate into something at 2.5% expense ratio. It will translate into how much if that expense was 2% or 1.5%, and that difference could be very meaningful if you look at the gains, because investors tend to look at the whole accumulation. Basically, your capital is not something which is where the fund company is contributing anything. That is the money which you are putting anyway. So you have to see the difference in return achieved at various expense ratio.
All right, so if you want aggressive returns, then it does make sense, of course, to pick the fund that has this larger mid-cap allocation. And like Narendra said, the expense ratio always makes sense if you want to base your decision on that, do that as well. Welcome back. You're watching Investors Guide in ET Now. It's time now to have our big fund review. And this week we're looking at the Birla Sun Life 95 fund. Avan is going to take you through the history of this 20-year-old fund, and then we'll come back and talk about it.
Thanks for that, Faye. Under the scanner this week is the Birla Sun Life 95 fund. The fund was launched in 1995 and is one of the oldest balanced funds in India. In the last 20 years, the fund has given a return of 22% and has built a loyal following of investors who rely on its stable fund management. While the fund has been a steady performer, it hasn't managed to get anywhere near the top of the chart for many years now. It tends to settle somewhere in the middle of the ranking order. In terms of the portfolio, equity comprises a minimum of 60% of the portfolio mix, while fixed income securities make up the rest. So should you continue holding this fund in your portfolio? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for that information. Narendra, Birla Sun Life 95, as the name suggests, is 20 years old right now. And it's been one of those steady, stable funds that investors have been trusting for a very, very long time. I have noticed, and a lot of our viewers have also noticed, that the rating has come down to 3 stars on Value Research. Now, from a risk-adjusted point of view, has the fund been slipping lately?
No, the fund has been actually, on the performance scale, the fund has been improving. But it has been little more volatile compared to others in the category in last 3 years. And that is what has dragged its rating. But on the performance scale, this has been an outstanding fund and has done little better in recent times.
All right, Narendra, finally to wrap it up, what rating would you give the Birla Sun Life 95 on Investor's Guide?
I'll be inclined to give it, 4-star rating, simply because, in this particular balanced fund universe, it has slipped marginally to look like a very average fund on the rating scale, which may not be the case.
All right, 4 stars there for the Birla Sun Life 95 fund on Investor's Guide. Let's move on now to our very popular Hold or Sell segment. Raghav Savarwal has written in the Narendra. He's 34 years old. He's been investing in funds for long-term wealth creation. He tells us he wants us to help him, tell him whether his portfolio is on track or not. And he has sent us 2 different stacks of funds. One is the regular SIP. He hasn't told us exactly how much money he's investing in the SIPs, but he also has a list of funds that he's been making lump sum investments into over the last 1 year, after repeatedly telling you, Raghav, not to do that, to not make lump sum investments, especially in a market like this. Then he does have a list of offbeat funds, infrastructure, small cap, mid cap, that sort of thing, that he's been making direct investments or lump sum investments into. Let's take a look at his list of SIP funds first. Right on top, HDFC Top 200. In a volatile market like this one, do you think this old and steady player should continue to be part of all of our portfolios?
Yes, old and steady player, and he should continue with this investment.
The IDFC Sterling Equity Fund is the next on his list, Narendra. It hasn't popped up on any of the portfolios we've looked at in a while, but this is a good performer as well, isn't it?
IDFC Sterling Equity is a fairly decent fund. It's managed conservatively despite being a mid-cap fund, and it has beaten its benchmark by a wide margin over most time period. So it's a good mid and small cap fund to have.
But I want to take the next 2 funds together because we just talked about them on the show. ICICI Prudential Focus Blue Chip Equity and, of course, the iPru Value Discovery Fund. I know both of these funds rate fairly high on your list of funds to have for long-term investors. Should he continue those SIPs?
Yes, he should continue with these SIPs. And these are, very different kind of fund. Though they come from the same fund family, they're managed differently and they will behave differently in all kind of markets.
Well, the last fund on his list is the DSP BlackRock Micro Cap. Narendra, continue this investment as well?
Yes, if it can actually withstand the kind of wild swing it will provide, because this will be a roller coaster. This is a fund which will be the most disappointing fund if the market gets into a declining phase, as was in 2013. And good times, this will be a blockbuster. So it is extremely important for it is suited only for an investor with that temperament, who will continue investing in lean times and will not get unnerved.
Well, Narendra, let's go over his list of funds that he put a lump sum investment into last year. And this list is interesting, so I'm going to take them one by one so we can talk about them, especially if the rest of our viewers are interested in the names as well. DSP BlackRock Tiger Fund. And I know that this fund incidentally made a sort of a comeback after the new government, or the Narendra Modi government, took over around the same time last year. That government has been here now for a year. Infrastructure funds came back into focus. DSP BlackRock Tiger, HDFC Infrastructure. I'm sure these funds were sold on that theme. Would you recommend he holds on to these investments now?
No, I really wonder that, given that his overall portfolio, where he's investing regularly, he's on a disciplined track. I don't see a reason for that. I don't see a reason for holding these. And it is very important to, it is very important for investors to look at, their opportunity losses and the lack of conviction or the lack of discipline and how much it can cost you. Many investors think that, all right, I invested this and lost a little bit. But the moment you get distracted from your regular investment plan, there's a likelihood that you will be you will be in for worse surprises, because that actually takes you off track from a disciplined investment track. An investor should form some principles and strictly follow it.
Resist the urge to be caught up in whatever is going on right now, especially if it's, politics and things like that, and someone comes and sells you a theme or an idea. You should have enough conviction in your investments to not change your plan. HDFC Mid-Cap Opportunities, Reliance Small Cap Fund, and DSP BlackRock Small and Mid-Cap Direct, Narendra. He's made these investments about a year ago. So he shouldn't be doing too badly, because the mid and small cap category over the last 1 year has been the top performing category among mutual funds. Would you recommend he continues these investments?
Yes, one, he continues his investment and be aware of, the kind of downside which this fund will show, and be prepared for it. If this was one tactical investment and he has been lucky, he invested before, a year ago before the government was formed, and now he is sitting on some substantial gains, then he should realize it and put that money on his long-term portfolio in a methodical way. And I don't think it will be a missed opportunity. It amounts to timing a bit, in a sense that he's taking his money out from equity and will be putting it, spreading his investment over a period of time. But I would say that it is worthwhile doing this, being on a track. And if he has to, maybe he should consider, opening a SIP. If I have to choose one, or he already has DSP Micro Cap, where his SIP is on, and he can well consider adding HDFC Mid-Cap Opportunity, holding it, and then starting a SIP.
All right, Narendra, thank you so much for answering our questions on the show. Remember, if you'd like us to take a look at your investments, you can get in touch. There's an email ID at the bottom of your screen. There's my Twitter handle, and of course, Narendra's on Twitter as well. You can reach the both of us directly if you'd like to. Welcome back. You're watching Investor's Guide on ET Now. Last weekend, Parag Parikh, Chairman and CEO of the Parag Parikh Financial Services Company, passed away quite suddenly while travelling overseas. Parag was an insightful and successful value investor. And he was always so very generous with his time and his advice for retail investors like you and me, and especially for this show. I was very fortunate to have spent several hours interviewing him and learning from him on this very show. In fact, I'd like to play for you a few clips from the last interview we did with Parag, because I believe that much like his charm, his advice would live forever.
Ask yourself whether you are an investor or a punter who has just entered because the markets are good. Had the retail investor been a good long-term investor, he would have bought it last year. When stocks were available very cheap, nobody was buying. But today, because the sentiment has changed, everyone wants to come in here to make a fast buck. So if the retail investor is trying to do that, you are going to be paying excessive money for the stocks you buy. So it's not that values will not be available, but just getting into the market because everyone is getting in, just because of the herd mentality, then you are bound to be a loser. Secondly, as an investor, as a retail investor, you have to consider that investing is a game of patience. You have to follow the law of the farm. You cannot sow something today and reap tomorrow. A seed which has been sown has to go through different seasons over a period of time before it turns into a fully grown tree. Similar is the case with investments. So if retail investors are thinking just get in and just make some good money, it's not going to happen.
So tell me, for somebody who's looking at getting into the market right now, what is the best way to approach this market?
See, I'll tell you first is go through a mutual fund route and go through your SIPs. So that way you are actually going through the good times as well as bad times, because there is a concentrated effort to be in the markets, and a good fund manager can over a period of time give you good returns. So my advice to them would be that instead of just going and buying the next hot stock in the market.
Unlike a lot of other AMCs, you only have one fund.
One scheme.
One scheme. Tell us why you only have one scheme.
When you launch a mutual fund, what is important is your fund manager is able to take every investment opportunity that comes in the market. So you devise your scheme in such a way that your fund manager is given all leeway to participate into every investment opportunity in the market. That was what our idea was, that we don't want to have a supermarket. We wanted to invest money for people, give them the right returns. For us, this is a profession, and for those who have multiple schemes, it has become a business, and that's why marketing has taken over stewardship. We have kept our mutual fund as because we believe we are stewards of the money which is entrusted to us.
If I understand correctly, you and all of your employees have also invested in the same fund?
Yes, definitely, because I can't ask you to invest if I myself don't invest. It is because we believe in what we are doing. And I think that is one of the finest points, that not only myself, my directors, my fund managers, but even my employees. Because today when you are managing money, you have to have a vision where you want to go. So you have to be focused, and investors need to understand what you really stand for. That's why even on our form, in red colors we write that anybody having an investment horizon less than 5 years, this fund is not for you.
Tell me this, you're also using what you call behavioral finance to manage the money in this scheme. Tell us how you use behavioral finance and what it is.
It's don't follow the herd. So when everyone is going that way, do you have the courage to be away from that herd? Secondly, they're saying our scheme, only one scheme, no more schemes, value investing, telling the clients that okay, less than 5 years don't come. You can't be everything to everyone. And behavioral finance is about that what do you want to stand for? See, we have to stand for something in life. So you stand for this, and whom do we want? We don't want every Tom, Dick and Harry. We want all those people who believe in our long-term investment philosophy. You come to us.